Welcome to the Real Credit Talk Show, audio edition. I'm your host, Tiana Mayers, also known as Lady T. Founder of Beyond Credit Limits Corporation. And this is where we break down how credit actually works. Not from opinion, not from guesswork, but from how the system is designed to read you. This is a Beyond Credit Limits production. If you want to understand how your situation connects to what we talk about here, you can visit www.beyondcreditlimits.com. And if you've been tapped into the brand, you already know what it is at thatmerchmove.com. This is a space where we stop repeating credit myths, stop chasing surface level advice, and start breaking down how the system actually works. Not the watered down version, not the social media version, not the version people throw around without context. The real version, the structured version, the version that helps you understand what is actually happening when your name, your information, your accounts, your behavior, and your decisions all come together inside a credit profile. So wherever you're listening from, I want you to settle in. Because this conversation is not just about credit. It's about how your profile is being read before you ever get an answer. Now let's go. Tonight is not about your credit. Let me say that again. Tonight is not about your credit. Tonight is about the tools, the ones being marketed to you, the ones being sold to you, the ones showing up in your social media feed with promises about what they can do for a profile that is just getting started or trying to come back from something hard. Secured cards, credit builder loans, rent reporting services, buy now, pay later programs, products claiming they will build your credit if you just sign up and pay the fee. Some of them work. Don't get me wrong. Some of them take your money and add almost nothing meaningful to the profile. And most people cannot tell the difference until months have passed and the profile looks exactly the same as it did before they started. Tonight, we close that gap. We go through every major credit building tool and tell you the truth about what each one actually does inside the profile. Not what the marketing says, what it actually does. Let's go. Welcome to episode 8. Episode 8 of the Real Credit Talk Show. I'm Tiana Mayers, Lady T. There is a moment that happens for a lot of people when they decide they are serious about their credit. They look at the profile. They see what is there or what is not there, and they decide they're going to do something about it. And the first question they ask is, where do I start? And the internet has a lot of answers for that question. Get a secured card. Open a credit builder loan. Sign up for rent reporting. Add yourself to someone's account. Use this app, this product, this service. And so people start signing up, paying monthly fees, waiting for results. And sometimes the results come. And sometimes 3 months later, the profile has barely moved and nobody can explain why. Today, I'm going to explain why. We're going through every major credit building tool, what it is, what it actually contributes to the profile, what it does not contribute, and what you need to know before you spend $1 on any of it. Because the right tool used correctly can genuinely move a profile. And the wrong tool used without understanding can cost you time and money with almost nothing to show for it. We'll be right back.
Most people think credit is just a score. It's not. Your credit can affect where you live, what you drive, your interest rates, approvals, deposits, business funding, and even the opportunities available to you. At Beyond Credit Limits, we help consumers understand how the system actually works. This isn't about gimmicks. This is about structure, strategy, education, and financial positioning. Whether you're trying to rebuild, organize your financial profile, understand collections, prepare for home ownership, or create a stronger financial foundation, Beyond Credit Limits was built to help you move with intention. The consultation is where everything starts. We review your situation, identify what's happening inside your credit profile, and map out the next steps based on your goals. Stop guessing, stop moving blind, and stop letting misinformation cost you financially. Visit www.beyondcreditlimits.com and fill out your consultation today. Again, that's www.beyondcreditlimits.com. Beyond Credit Limits, because financial freedom starts with understanding the system.
And we're back. Let's get into it. Before we talk about any credit building tool, we need to talk about what we are building from, because not every person starting this conversation is starting from the same place. Some people have a damaged file, negative marks, collections, late payments, derogatory items. History exists, but it is working against them. Some people have a thin file. A thin file is different. A thin file means there is not enough information on the credit reports for a scoring model to make a confident calculation. Not enough accounts, not enough history, not enough data to produce a reliable score, or in some cases, any score at all. FICO requires at least one account that has been opened for at least 6 months and has been reported to the Bureau within the last 6 months before it will generate a score. If those conditions are not met, the file is considered unscorable under that model. And an unscorable file is not the same as a bad file, but it creates its own set of challenges because lenders cannot evaluate what they cannot measure. VantageScore can generate a score with less history, sometimes with as little as 1 month of reported activity, which is why some monitoring apps show a score when the person does not yet have a FICO score at all. Knowing whether you are working with a thin file or a damaged file matters because the tools that help are not always the same, and the strategy is not the same. Thin file needs depth. Damaged file needs correction and rebuilding. Sometimes it needs both. Everything that follows in this episode needs to be understood through that lens. A secured credit card is one of the most commonly recommended credit building tool. Here's how it works. You provide a cash deposit, typically between $200 and $500. That becomes your credit limit. The card issuer holds that deposit as collateral. You use the card like a regular credit card. You make purchases, you make payments, and the account gets reported to the credit bureaus. What it adds to the profile. A secured card adds an activity revolving trade line. It contributes payment history, the single most weighted factor in most scoring models. It adds to available revolving credit, and over time, it adds to the age of the credit file. When used correctly, a secured card can begin to move the needle on a thin file within the first few months of reporting. But here is what most people are not told. Not all secured cards report to all three bureaus. This is critical. If the card does not report to all three, Equifax, TransUnion, and Experian, it is only building credit at the bureaus where it does report. And if a lender pulls the bureau where it does not report, that account does not exist in that evaluation. Before opening any secured card, confirm which bureau it reports to. All three is the standard you are looking for. Not all secured cards are created equal. Some have annual fees. Some have monthly maintenance fees. Some have high APRs that make carrying any balance costly. Some have pathways to graduation, meaning they convert to an unsecured card and return your deposit after a period of responsible use. Others do not. A secured card with a graduation pathway serves two purposes. It builds the profile while you hold it and eventually returns your deposit and transitions to an unsecured card account that continues aging on the file. A secured card with no graduation pathway only builds credit as long as you keep it open. The moment you close it, the account stops growing and you lose the deposit. Fee structure, bureau reporting, and graduation pathway. Those three things matter before you choose a secured card. A credit builder loan is a product specifically designed to add installment account history to a thin or rebuilding credit file. Here is how it works, and it is different from a regular loan. With a credit builder loan, you do not receive the money up front. Instead, you make monthly payments into a secured account held by the lender. Those payments are reported to the credit bureaus each month. At the end of the loan term, you receive the accumulated funds minus any fees and interest. So you are essentially paying to build the history and receiving the savings at the end. What it adds to the profile. A credit builder loan adds an installment trade line. This matters because credit mix. Having both revolving and installment accounts is a factor in most scoring models. Someone with only a secured card has revolving history. A credit builder loan adds installment history alongside it. Together, they create a more complete profile picture. What it does not do. It does not add revolving credit. It does not increase available credit limits. And if the payments are missed, it adds negative installment history, the opposite of the intended outcome. Credit builder loans are most commonly offered through credit unions, community banks, and some financial technology companies. Before opening one, confirm that it reports to all three credit bureaus. What the total cost in fees and interest will be, and what the monthly payment commitment is before agreeing to a term you cannot sustain. A credit builder loan missed is worse than no credit builder loan at all. Every payment counts, including the ones that do not get made. Rent is typically the largest monthly payment most people make. And for the most of credit history, it counted for nothing in the credit profile. Rent reporting services emerged to change that. They connect to your rental payment history through your landlord, through your property management system, or your banking transactions, and report those payments to one or more credit bureaus. What it can add. Positive rent payment history reported to the bureaus can add payment history data to a thin file. For someone who has been paying rent on time for years but has little else on the credit profile, this can be meaningful. What it does not always do. Not all bureaus accept rent payment data equally. Experian has been the most receptive. TransUnion accepts it in certain formats. Equifax has been more limited. And not all scoring models use rent payment data even when it is present on the credit report. FICO 8, the most widely used general model, does not factor in rent data. FICO 9 and VantageScore 4.0 do use it when it is reported through specific channels, which means if the lender you are working toward uses FICO 8 or an older model, the rent reporting you paid for may not appear in the evaluation at all. Rent reporting is not worthless, but it is not the universal credit builder it is often marketed as. Knowing which bureau accepts it and which model uses it matters before you pay for the service. Buy now, pay later programs have become part of everyday spending for millions of people. You purchase something, you split the cost into installments, you pay over weeks or months. Simple enough, right? But what most people do not know is what these programs do or do not do to their credit profile. The short answer is that it depends entirely on the provider. Some BNPL, buy now, pay later providers report to one or more bureaus. Some do not report at all. The reporting is not standardized across the industry. When BNPL does report, it typically shows as an installment account, short term, small balance. Multiple BNPL accounts opening and closing frequently can create noise in the profile. Multiple new accounts, multiple closed accounts, in a pattern that does not necessarily help. When BNPL does not report on-time payments, but does report missed payments, you get the downside without the upside. Some providers operate exactly this way. Before using a BNPL product with the expectation that it will build credit, know whether it reports, to which bureau it reports, and what happens to the profile if a payment is missed. A BNPL product used for convenience is a spending decision. A BNPL product used for credit building requires knowing the reporting structure first. Being added as an authorized user on someone else's credit card account is one of the oldest credit building strategies. When it works. When the primary account holder has a well-managed card, long history, low balance, consistent on-time payments, being added as an authorized user can attach that positive history to your profile. It can add account age. It can add available revolving credit. It can add positive payment history. For a thin file, this can be a meaningful contribution when it does not work as expected. Some scoring models, particularly Newer FICO versions are designed to recognize and discount authorized user accounts because they are aware this strategy exists. The contribution may be smaller than expected, depending on which model evaluates the profile, and if the primary account holder carries high balances, missed payments, or has the account closed negatively. All of that attaches to the authorized user's profile as well. The risk is real, and it is proportional to how well the primary account holder actually manages the account. Being added to a well-managed account by someone you trust can be a useful step in building a thin file. Being added to an account without knowing its full history and current status is a risk that can work against the profile rather than for it. Now that we have walked through every major tool, let me tell you what actually works, and more importantly, in what order. Because the tools themselves are not the strategy. The sequence is the strategy. For a thin file with no negative history, the goal is to add depth without creating disruption. Start with one secured card that reports to all three bureaus and has a graduation pathway. Use it for small recurring purchases, paid in full every month. Let it season for at least 6 months before adding anything else. After 6 months of clean history on that card, consider adding a credit builder loan to introduce an installment trade line alongside the revolving one. Now the profile has 2 account types, 2 streams of positive payment history, and it is building depth. After 12 months of that combination, the profile has enough history for a scoring model to start reading it with confidence. For a damaged file with negative history, the approach is different. Adding a new positive account does not erase old negative ones. It supplements them. New positive history begins to dilute the weight of the negatives as time passes and the positive record grows. But the negative items still need to be addressed strategically. New accounts alone are not enough. They are one part of a broader strategy, not the complete solution. The tools that work are the ones that report to all three bureaus, fit the specific gap in the profile, and used consistently without disruption, and are given enough time to season before the next move is made. That is what works. Not the product with the best marketing. The right product in the right sequence, used correctly and consistently over time. Not every product marketed as a credit building tool delivers meaningful results. Here are some of the patterns to recognize. Products that report to only one bureau. A product that only reports to one bureau builds credit at that bureau only. If the evaluation that matters to your goal uses a different bureau, the history you built may not show up at all. Products with high fees relative to their contribution. Some credit building products charge monthly fees that reduce or eliminate the financial benefit of the credit builder loan's savings component. If the fees cost more than the benefit delivered, the product is working for the company's revenue, not for your profile. Products that report positives only and not negatives until you miss. Some BNPL providers and subscription services do not report on-time payments, but do report missed ones. This means the product adds nothing to the profile when used correctly, but damages it when something goes wrong. That is not a credit building tool. That is a credit risk. Products promising rapid score increases. Credit building takes time. Accounts need to season. Payment history needs to accumulate. Any product promising dramatic score changes in 30 days or less is either misrepresenting what it does or exploiting a temporary scoring quirk that does not represent real profile strength. The questions to ask before any credit building product is, does it report to all three bureaus? What type of account does it create in the profile? What does a missed payment do? What is the total cost relative to the profile contribution? And is this the right tool for the specific gap in my profile right now? Those questions protect the profile and the wallet. One of the most important things to understand about credit building tools is that they work on a timeline, and that timeline cannot be significantly compressed. An account opened today does not have meaningful age for at least 6 months. A payment history that is just beginning does not demonstrate consistency until several cycles have accumulated. A thin file that starts with one secured card does not have the depth to support a mortgage application in 90 days. These are not limitations of the tools. They are limitations of time. And time is the one thing no product can replace. Here is a realistic picture of what a thoughtful credit building strategy looks like over time. In the first 3 months, the accounts are new and the history is minimal. The profile may not show significant movement yet. This is normal. This is not failure. The foundation is being laid. Between 3 and 6 months, the first meaningful pattern of payment history begins to establish. A scorable file may emerge if one was not present before. Early movement becomes visible. Between 6 months and 1 year, the profile starts to read with more confidence. The mix of accounts, the age of the oldest account, and the consistency of the payment record all begin to contribute more meaningfully. At 12 to 24 months of consistent, correct use, a well-built credit foundation can position someone for credit opportunities that were not accessible at the starting point. That timeline is real. And anyone telling you otherwise is selling you something the timeline cannot support. Before we get into the questions, if tonight's episode raised questions about your own credit situation, if you are wondering which tools are right for where your profile stands, or if you are not sure whether you have a thin file, a damaged file, or something in between, that is exactly the kind of conversation a consultation is built for. Visit www.beyondcreditlimits.com and fill out the consultation form. We will look at your specific situation together and map out what your next step actually needs to be. And if you have a question you want answered on this show, submit it to the Real Credit Talk Show at beyondcreditlimits.com. Tell us your first name and state where you are from, or submit anonymously. Your choice. I read everyone. Now let's get into the community questions. Liliani from Hawaii. I have a secured card for 4 months and my score has barely moved. Did I do something wrong? Liliani, 4 months is still early in the building process. The first thing to confirm is that the card is reporting to all 3 bureaus. If it is only reporting to one, the movement will be limited because the other 2 files are not seeing the history. The second thing to consider is utilization. If the balance being reported each month is high, even on a small limit, that can offset the positive payment history the card is supposed to be building. The balance that reports should stay low relative to the limit. And the third thing is time. 4 months is a foundation. The profile typically begins to show more meaningful movement closer to 6 to 12 months of consistent history. Stay the course, but confirm the card is reporting correctly first. Kiowa, Alaska. I am hoping that I am saying your name right, and my apologies if I'm not. I signed up for 3 credit building apps at the same time. Was that a mistake? Kiowa, it depends on what those apps are doing to the profile. If all 3 are opening new accounts simultaneously, the profile now has multiple new accounts at the same time. That lowers the average age of the accounts and can create the appearance of rapid credit-seeking activity. More accounts does not always mean more building. One account used correctly over 12 months typically produces better results than 3 accounts opened at the same time and managed inconsistently. The better approach going forward is to let what you have open season for several months before evaluating whether to add anything else. Let the history accumulate before layering in more. Anonymous from Vermont. Is a credit builder loan worth it if I already have a secured card? It can be, and here is why. A secured card gives you a revolving trade line. A credit builder loan gives you an installment trade line. Having both types of accounts in the profile contributes to credit mix, which is a factor in most scoring models. If you have had the secured card for at least 6 months and it has been reporting clean payment history, adding a credit builder loan at that point introduces a second account type without the disruption that comes from opening everything at once. Timing matters. Sequence matters. 6 months of established history first, then the next layer. Amara, New Mexico. Does closing a secured card hurt my credit after I graduate to an unsecured one? Amara, this is an important question, and the answer matters. When a secured card graduates to an unsecured card with the same issuer, the account typically remains open and continues aging. The history carries over. The account number may stay the same or update, but the age of the relationship usually is preserved. That is the best outcome, graduation, not closure. If the secured card is closed rather than graduated, that account stops aging and the available credit goes away. Depending on what else is in the profile, that closure can affect both the length of credit history and the utilization ratio. When you are at the point of graduating, ask the issuer specifically whether the account stays open or whether the secured card closes and a new one opens. That answer determines the right move. Submit your question to the Real Credit Talk Show at beyondcreditlimits.com. Your name and state, or anonymous, your choice. And if your situation needs a closer look, visit www.beyondcreditlimits.com and fill out the consultation form. Let's map out your specific Next steps together. We started this episode by talking about tools. And by now, you understand that the tool itself is only part of the equation. A secured card that does not report to all three bureaus is building credit in one place while leaving the others untouched. A credit builder loan where payments get missed is damaging the profile it was supposed to help. Rent reporting that uses a model no lender pulls is adding data that does not affect the evaluation that matters. Buy now, pay later, BNPL, used without knowing the reporting structure, is a spending tool being mistaken for a credit tool. And multiple accounts opened at once without understanding what they collectively do to the profile is activity that looks like building but may be working against the goal. The right tool in the right sequence, used correctly, given enough time to season. That is what actually works. And knowing the difference between that and everything being marketed to you is exactly what tonight was built to give you. If there is one thing I want you to take from episode 8, it is this. Credit building is not about how many products you open. It is about which products you open, why you open them, how you use them, and how long you give them to work. The industry that sells credit building tools makes money when you buy the product. It does not always make money based on whether that product actually moves your profile. So the responsibility of knowing what works falls on you. And now that you have that knowledge, you know what each tool adds, you know what each tool does not add, you know the questions to ask before you spend $1, and you know that the sequence matters just as much as the selection. Build with intention, not with urgency, not with volume, with the right tools in the right order, given the right amount of time. That is how a thin file becomes a strong one. And that is how a damaged file starts to tell a different story. Before I close, I want to leave you with this. No question is insignificant. Your questions matter because you matter. And if tonight's episode made you think about where your own profile stands, whether you are starting fresh, rebuilding after something hard, or trying to figure out which tool is right for the specific gap in your credit picture, that is exactly the conversation a consultation is built for. Visit www.beyondcreditlimits.com and fill out the consultation form. We will look at your credit situation specifically, not generally, and map out the next step that actually makes sense for you. Submit your questions to the Real Credit Talk Show at beyondcreditlimits.com. Your first name and state, or anonymous, I read every one. And your question may be answered right here. Ask the question. Respect the process. Use the right tools in the right order. And move with the kind of intention that only comes from understanding what you are building and exactly what it takes to build it right. This has been the Real Credit Talk Show, hosted by me, Tiana Mayers, Lady T, founder of Beyond Credit Limits Corporation. Visit us at www.beyondcreditlimits.com. And if you know the brand, you already know www.thatmerchmood.com. Until next time, keep learning, keep positioning, and keep moving with intention. Have a good night.